SEBI just discontinued retirement funds. They also introduced something called Lifecycle funds. Now, what does all that mean for the longevity or retirement corpus that you and I have been building?
Most of the retail investors do not hang around in a fund for more than a year or 2.5 years, maybe 3 years in average. This product is probably only suitable for those investors who are going to do DIY. And in other words, he is also trying to say that most of the advisors and financial planners, brokers, be not advise this product. From a longevity point of view, you need to be more invested in equity instead of being lesser invested in equity.
So here's what's been happening. There's a war, as you know, and markets are falling. The Indian stock market regulator SEBI just discontinued retirement funds. They also introduced something called life cycle funds. Now, what does all that mean for the longevity or retirement corpus that you and I have been building? That's the question we are seeking answers to on this edition of the Longevity Shot with Kartik Jhaveri. Kartik is the Director, Investments at Transcend Capital. Kartik, welcome.
Thank you very much, Kartik.
So a bit about Kartik. Now, he is among India's top financial planners. You've probably seen him on television. We've done shows together. And in fact, you could have possibly got his courses or webinars online. Now, his day job is literally managing money and making it grow. So, Kartik, you've also joined us earlier on Longevity Short. You're not a stranger over here. We discussed then, how to build a corpus for the 100-year life. So tell us how does that, you told us over there then how that sort of differs from merely saving for retirement.
Correct.
Now, in the light of that, let's look at SEBI's latest notification. They've discontinued retirement funds. So what does that mean for investors in these funds?
So, we don't need to worry too much about the fact that they've discontinued the retirement fund. And these are known as solution-based funds. So not only retirement, there was something called a children's fund also, which is also discontinued. I have always believed that these labels are of great help to people, especially who are DIY investors. So these labels are of great use. And it's one fund, like this is a children's fund. So maybe a handful of mutual funds are running it. Retirement, handful of, again, mutual funds are running it. It's very simple. It tells you this is a fund for your retirement. So psychologically, you don't want to pull away money from there. And you will invest only in that if you want to hold on for that kind of a period, or at least a reasonably long period of time. So you are definitely mentally prepared not to pull out money too soon. I thought it was a good idea. But the reason we are saying it's okay, it doesn't matter so much because, the total funds, the total AUM or the assets that these mutual funds are managing in retirement and the children's was close to about 57,000 odd crores, the last available number. Now, this is against the backdrop of almost 40 lakh crores or 42 lakh crores that are there in the equity assets for all the mutual funds put together. So if you look at this, what was the percentage that this fund was having? Was it really significant or important? It's barely like 1.5% or so, 1.3%, So not a significant percentage of assets, which is to say that not a lot of people are buying it. Perhaps that way, maybe SEBI thought, let me make something even better and clever. And what will happen is that, the pie will grow and there will be a whole new opportunity for all the mutual funds together and for all the investors together. And which is why perhaps they launched these life cycle funds, as they call it. And for doing that, they took a decision to scrap these two funds.
Okay. But what happens if I have money in these funds now? They are merged with another existing fund?
So what they are going to do is they said that they will move the money or merge that particular scheme with a suitable scheme. Now, that is quite ambiguous to me. Suitable means, I could be a 30-year-old person who actually and genuinely put money into the retirement thinking that, I will sort of pull out money when I'm 50 or 55. And there could be somebody who's 45 also who's going to who's thinking he'll pull out money when he becomes 45. And the scheme runs permanently. That sort of a thing. But so I don't know. We have to wait for the further guidelines to come on retirement, how they are going to merge that with the existing schemes. But the children's fund is quite easy to understand, which is where, they might find that if a kid has got 5 more years to attain the age of majority, 18, then that fund will move somewhere into a 5-year kind of a fund. If the kid has got about 9 or 10 years, then he'll move into a 10-year corresponding life cycle fund. So I think that's what they will do. They have not done any clarification on this.
So I'm guessing that it means for as investors, if we have our money in these funds, what we need to do is wait and watch for any, any sort of
For the time,
intimation either from SEBI or from the mutual fund house itself.
for the time being, yeah. And you will always get the exit to the option to exit if you don't want to continue.
But let's talk about life cycle funds now.
Yes.
Whatever I've read about it, it does sound like what it does sound like it is suited to longer lifespans. Is that the case?
Um, yeah, it is suited to longer lifespans. That's pretty obvious. They want to do it that way, but the reality is quite different. I mean, SEBI and AMFI's own statistics. I mean, if you just do a quick Google, also, one of the first. So I just thought to my mind, and I did a Google search myself, saying that what is the average time an Indian investor holds a mutual fund? So now I do not have the real data that mutual funds are actually experiencing. I just asked Google. And the answer I got was 2.5 years, which is as per some AMFI report. So, as per the AMFI report, if they are saying most of the retail investors do not hang around in a fund for more than a year or 2.5 years, maybe 3 years in average, how are they going to even do a 5-year fund? And how are they going to hang around in a 10-year fund? Forget about talking of a 30-year fund. So, this is an insurance policy is different. People hang around for a long time. But here in the fund, whether they will hang around, whether they will have incentive enough to hang around, too many questions and too many challenges to my mind as of now. Does it serve the longevity purpose? The answer is yes. From from the theme that you are representing, if the person got invested in that fund and remained invested for 30 years, then sure, it does serve that kind of a purpose, because at least you know that you will be invested for 30 years. If not, so that means if you're retiring, say at 60, just taking an average, you know that a 30-year-old will be motivated to get in. But whether or not he will somebody advise him to do that or not, him or her, that's a little bit of a...
There's also an exit load, and the exit load over here is pretty high as compared to a regular mutual fund.
Correct.
From what I understand. Is that because SEBI wants to deter people from, getting out of it early, like you said?
Honestly, that's the obviously that's the understanding that if you want to get out, you'll have to pay 3% as an exit charge. But the question is that SEBI, while in their in their circular, they've created this product. The question that I have, and for that matter, question that a lot of people have, is actually who's going to buy this product in the first place? Okay, I mean, exit load. The question of exit loads comes when you're going to get into this product. But are you really going to get into this product? Because, I think there should have been a lot of work done before you launch some sort of a solution-based concept of this sort. And you will see, I mean, time will tell. Incidentally, there was, today's Economic Times also spoke about that. I mean, in the ET Wealth section, he asked the question, and towards the end, he says that this product is probably only suitable for those investors who are going to do DIY. And in other words, he's also trying to say that most of the advisors and financial planners, brokers, being not advised this product because there are certain challenges in this.
Okay, so clearly you've made it very clear that it's not a great product per your recommendation, at least.
At the moment, in the form and design that we have.
So first explain to us what is this life cycle fund, how is it supposed to work, and what are the reasons you think is not suitable?
So, see, as a fund, it's a great solution. Okay. So what happens is that when you are young, the ideology is that you should be in a position where you can take more volatility, you can stomach more risk, and therefore the equity proportion is much higher when you're starting off. And then as time passes by, it sort of reduces, that equity component reduces. And so the idea is that when you're 30 years old, if you get into a 30-year product, the equity exposure could be as high as 80 to 90%, 95%. And then as you move along the product, it keeps reducing over a period of time. So by the time you actually reach your maturity, and the way this maturity is looked at is because there are multiple products here of 6 different tenures, 5, 10, 15, 20, 25, and 30. So assuming that you're in the 30-year product, as you're moving towards the 30th year, the equity percentage would go down significantly, thereby reducing the risk. reducing the volatility. But then the immediate challenge is the returns also will reduce, right? The compounding factor. See, the reason we say that an equity fund will do 14 or 15% is because there is an implicit assumption that the equity fund will have 100% equity, and the fund manager will decide that if there is a time that he doesn't want to be in equity, he can reduce and hold maybe 80% equity, 20% cash. And then when the time is opportunity is right, time is good, he will probably increase and decrease. He'll calibrate it according to his discretion. But as an investor, you know that you will come with the 14, 15. So here the fact that the equity percentage is going down, automatically one of the immediate challenge becomes is your returns will not be steady and 14%. It will be actually declining over a period of time, which is something psychologically nobody wants to accept. And nobody would want to. Even a 60-year-old person, if you say that, look, I'll give you a return which will fall over a period of time, maybe he doesn't want that. So that is like, I would say, the number one challenge in this. But idea is good. Stay invested. As time moves on, the equity percentage goes down.
Okay. Now, this fund also invests in multiple asset classes. Am I right? It's
That's
not
right.
just
Absolutely
equity
right.
that we're talking about. So,
Correct.
which are the other classes? And would you say that for volatile times like the ones that we are living in right now, uh, is that like a good cushion to have?
Yes and no again. You see, yes, it's a very good idea to have multiple assets. But the way the design has been made, they have said that yes, you can invest in equity, you can invest in debt, you can invest in gold, in silver, in infrastructure, investment trusts, things like that. There's a variety of assets. You can also hold cash. But then when you start looking further at the caps, then you see that for infrastructure, other than equity and debt, everything else has been put together in a 10% basket. So which means if the fund manager wants to buy 20% of gold, he can't do that. So gold, silver, infrastructure, investment trust, everything else is all bundled together in a 10% bracket. You cannot exceed 10. You can be from 0 to 10. Highly regimented. And versus in equity, you can be from whatever, 30 to 90 or 95 based on the age factor, and you can play around with equity and debt. So then it becomes quite similar to what you have is a hybrid fund already existing in the market. Then why did you even bring this thing if
That's
you don't?
exactly what I wanted to ask you. How is it
Yeah.
different from a regular hybrid fund, and then why not opt for a hybrid fund? Does a hybrid fund give the fund manager more leeway as opposed to this?
Um, kind of, yes. It gives the fund manager more leeway, but it is also, it's not so much about leeway, Kavita. It's more about consistency. See, the hybrid fund that we have today is saying that if you are into an aggressive hybrid fund, then 65% of your assets have to be in equity, minimum. So 65 can go up to 75, 85, but 65 have to be there in equity, which actually classifies that as an equity scheme. Which means as an investor, you can always expect that if you want to be invested in this scheme for the next 10 years or 15 years, you will mostly have an exposure of equity of minimum 65, and debt would be a minimum of 35. That you can always assume. But that's not the case here. This is going to change every few years. So in a hybrid fund, because the asset allocation is overall fixed, the opportunity and the returns that you will get from an asset allocation fund will be always higher than that of a lifecycle. Always. Because your equity is declining straight away. From 30 years, when you come to 25 years to 20 years, it's declining. Okay. The other thing that is happening is the little benefit that they've given is, okay, 10% do whatever else you want. But that 10% is not good enough. If you really want to make it a multi-asset fund, then you do what the current multi-asset funds have, where they even allow you to go into commodities to as much as 15%, 20%. So you give the fund manager leeway. Why are you trying to control how every fund should work? And on top of that, assuming 50 mutual funds and 6 maturities, so every mutual fund will every year launch 300 new products. And question is, how many of these products will have substantial amount of assets for them to be justified? Come 5 years and we will have 1,500 new products. 1,500 such lifestyle funds. And what they are replacing is only an asset which had, like we mentioned, 55,000 crores. So is there so much money which is going to come in? What is going to happen to the fact that you have so many other funds every year being launched? Okay, then there's another very important pertinent question. Suppose I'm in a 10-year fund for whatever reason, right? I decide that my financial goal is 10 years ahead. So I want to be in this particular goal. Now I find that the scheme that I am in is actually underperforming another scheme by another mutual fund, okay, who's also got the same 10-year scheme running, and that scheme is doing better, maybe by 3 percentage points better in terms of compound. So I'm going to feel quite horrible, because then can I take out my fund from company X or mutual fund X and go into mutual fund Y? I can't do that. Shifting within the mutual fund is possible, but shifting within the industry is not possible. Assume I realize this after 3 years, that now after 3 years, some other fund is performing better. I can't really take out my thing and I can invest into that for 7 years. I can't do that. So mismatch again. So a lot of questions and challenges like this.
Also, there is something else that SEBI says, that one is, of course, the 30-year maturity bit. It also says that towards the end, you have the option to merge with the nearest fund. Now, what does nearest fund mean, and how does it help?
Yeah, so that it's itself, right? So I mean, when you're finishing a 5-year maturity, okay, at a 5-year maturity, assuming that the equity component of that particular fund, and let's for example take a real so let's take a 5-year fund, right? So when this 5-year fund, they say, is going to be less than 1 year, then the equity percentage is going to be between 5 to 20. So they will say that when this 5-year scheme gets over, we will try and look at another scheme which has a similar asset allocation. So this 5-year scheme, and for that matter, all the other schemes, as they move towards below 3 years, below 2 years, below 1 year, they will all start getting merged into what is currently classified as conservative hybrid funds, which has about 30 odd percent, 35% equity, and the rest is debt and other assets. So everything will get merged into that. So which means you're going to create a product, and after a few years, it's going to get all that assets are going to move into your conservative fund. Again, there will be a little bit of a churn, there will be a little bit of a change, because the objective and the planning that the fund manager might have for this product would be very different from what he has for a conservative fund, because the conservative fund is meant for that person who wants FD plus maybe 1 or 2%. And he wants to have this, let's say, constantly for the next so many years. So we recommend that kind of a fund to a lot of our clients. That here is a fund which is only 30-35% in equity. It will stay steady. And then, then the rest of the money is in fixed income. The tax is higher, but the volatility is so much lower. Or, these designs were fixed. I think fixed design makes a lot of sense, where you're giving fund manager a clear mandate to do his job very nicely. The broker distributor like us have a clear mandate that this is a fund, it's not going to change its design and constitution, so long as this scheme is not wound up, and you don't really see winding up of scheme every now and then happening. So there is clarity in terms of the broker advisor's mind also when he's recommending, and the customer and the investor also is absolutely clear what to expect out of this product for the next 10-15 years. Now, this is an unknown species. Every few years, the asset allocation is changing. So what will you expect out of this thing? And if your fund is doing good, you're happy with it. If it's doing bad, you will obviously want to be invested in the fund which is better. And then you will not also feel justified about paying the fund management charge. And then not to mention the taxman will come later on and say, oh, this scheme, when it was born, it was equity taxation, but now it's got less than 65% equity. So I need to charge it like a non-equity fund, and I want to increase the taxes on this. So then there will be like lots of legislations in the tax area also. So I think this is just too fast kind of a measure made. See, because at 65, if I come from the premise that you're going to live for another 30 years, you're not going to consume all that money today. So why on earth would you drastically drop your asset allocation and equity from maybe even a 65, 75 to a 25? It doesn't make sense, because then again you will be far under inflation and things like that. So from a longevity point of view, you need to be more invested in equity instead of being lesser invested in equity.
So then let me ask you this question. So clearly you are advising against this particular product.
At the moment, the way it is,
as of now,
yes.
yeah. So, given that at the moment, what are the other products that are available to us, investment products that we could explore to, sort of build wealth for a longer lifespan?
What people are going to do is what people were already doing until yesterday. Nothing different. So we have the same blue chip funds and mid cap funds and small cap funds and sectoral funds and balance advantage funds and dynamic asset allocation funds, multi asset funds, flexi cap funds, multi cap funds. We have all this whole variety of funds available. The whole bouquet is already available with absolute clarity on who's going to do what and who's going to perform how.
So, what kind of mutual funds would you then advise? And
Kavita,
apart from mutual funds, what else should you be looking
Oh, apart from that, then you have, see, whether this way or that way, you still have to be in this space of equities, right? So then if you don't do mutual funds or don't want to go beyond mutual funds, then
No,
you have,
I mean, say someone wants to do like a mix, not just
Yeah,
mutual
yeah.
funds. Yeah.
So in terms of doing a mix, I mean, that mix is already available in terms of fixed income, bank deposits. You still have a variety of these funds which have multi-asset allocations. You will go into balanced funds which have maybe 60% debt and 40% equity, but that we calibrate based on the requirement and need. Beyond mutual funds, you can directly get into bonds that you can buy. You can buy into state government bonds. You can buy directly into treasury bills also to be on the safest side. You can buy government bonds, tax-free bonds. So you have a range from about 5.5%, 6% to as much as 10, 11%. Some of the state government bonds, sometimes they give you a yield of 10, 11% also. These days, the yields are at about 9.5%. Of course, the number changes every day, but you still have quite a variety of things. Then on top of that, you have private placements and private bonds also available. So there are today SEBI registered brokers who are debt brokers and who will give you debt investment in a single A company or a double A company if you want to take a little bit of a higher risk there. And you might even land up having a 11, 12% kind of a rate of interest product. You can buy that also. Of course, that is through secondary market, through the bond market. Of course, it comes back to your demat account. So then you've got that, you've got your real estate, you've got your banking products like fixed deposit, you've got your guaranteed products like your PPF. So I mean, you still have a lot of other things. It's not that this product is going to come and make a big splash and suddenly it's going to attract a lot of money.
Yeah, you mentioned PPF. I wanted to ask you about the NPS. Is that something that would make sense from a longer lifespan perspective?
NPS, right?
Yeah.
Again, yes and no. See, what happens is now NPS is a product where there has been a lot of regulatory changes and for the better. From the starting point where they said only 40% of the money is available as a commutation and 60% is going to be compulsory pension and taxable and all that. Now that number has kind of gone up to almost 60% and I hear even 80%, not too sure because there's too much happening in that space. But once the design is crystallized, it is still going under some regulatory changes. I don't know why it's taking so long, but NPS is here for a very long time. If not now, maybe 5 years down the line, 3 years down the line, if the regulation settles nice and clear, then it will become a very good product for people because then there's clarity. Now there's no change in regulation. Today, there is a little bit of a apprehension, although there is no commission or there's no brokerage, there's no earning mechanism for brokers for an NPS. But despite that, brokers are themselves not sure, even if I want to advise out of goodwill to somebody, how this product's design will remain over the next 10, 15 years. Tier 1, Tier 2, these things are all established long term, but just freeze the regulation once. Give us clarity. Once there's clarity, then, this product can go on. And this can be a great longevity product.
Yeah, so essentially what you're saying is the NPS has the meat in it to be a great longevity product, but we need to wait for the dust to settle. And as far as the life cycle fund that SEBI has just introduced, even there that looks like it needs a lot of work. So right now you're probably better off investing in any of the equity mutual funds that are available and other fixed income products like
and there's one beautiful category also, Kavita, that is ULIP. Why should we forget about ULIP? See, insurance companies have also become very clever. Everybody is there, the product which has very low fund management cost. In fact, half of that of a mutual fund or comparable to a mutual fund now. When these were launched about 8 years ago, mutual funds average FMC fund management cost was 225, 250, say 2%. And these funds were all launched at about 1%, 1.25%, 1.35%. And see, the most important thing is that you let the investor, and in discussion with his distributor or the investor by himself, let him or her decide what percentage of allocation you should have.
Just to give some insight over here, Karthik, I recall a conversation with you, like 10, 12 years back, where at
Yes.
which point you told me ULIPs doesn't make sense right now.
Correct.
But now you yourself are telling that, it has evolved to such an extent that it's a great longevity product.
And because we are on this subject, see, the whole world changed in 2018. So 2018, what happened is, in that budget of that year, they taxed equity and they brought long-term capital gain back on equity. Till such time, ULIP products were kind of high expense loaded at the earlier years, which is why financially it was not a very wise thing to do, because you would lose a lot in expense and charges. The moment they brought in long-term capital gains, suddenly the insurance companies, thought this is a great opportunity because ULIP is not taxed as yet. So let me launch products and let me actually give the benefit of tax-free returns for the rest of the lives of the investors. Okay, because this area is not taxed, because they thought it will never be taxed. So they launched a lot of products with zero cost, zero allocation. They suddenly in 2018, ULIPs just had a huge leap of product development. And they became very friendly, very easy to handle, very beautiful to sort of maneuver. Lots of fund options within the scheme itself. So you don't feel that even if you're in one company, you're missing out the variety of a mutual fund. Today's time, you have smart beta strategies, you have alpha strategies, you have all that also as fund options. You have index options also as part of your ULIP. So it's like a whole bouquet of funds that you have within that ULIP structure. And because the cost is so competitive and and probably is the least right now, is the lowest cost management product. So then why should you not consider ULIP? Because ULIP, typically it's an insurance policy. You'll hold it till 100 years of your life.
So if I were to ask you to, kind of sum up our discussion, give
Yes.
us 5 assets that we can invest in, equity, non-equity, to sort of plan our investments for the 100-year life. What would be your picks? 5 asset classes.
So one of them would be, of course, our mutual funds, ones that are existing and available already. Great flexibility, but it is taxable. Okay. ULIP now from 2021 onwards has also become taxable, but that's also a fantastic product, because within ULIP, even if you are switching, there's a big advantage. Even if you are switching, from equity to debt, debt to equity, if you're changing your allocation, if you're booking profits and all that, there is no capital gain on switching of ULIPs even now. Okay.
So say I'm in my 40s. Also tell me,
Yes.
how much should I be allocating to each of these instruments? You said mutual funds, you said ULIPs.
Okay, so mutual funds, Bhavya, you've got ULIPs as your other choice. You will have your debt funds because you need them from a hygiene point of view. Okay, you might want to, even think about perhaps 30% of your money you can divide, 30 or 40%. You can divide between PMSs also. You should even look at that, because there'll be some very smart, aggressive strategies that people will do there in PMSs. And so within the 30 or 40%, let's say some 20% to PMS, and 20% of your money perhaps international. So last year, 2025 was one of the years which was like a very big highlight, and it taught a lot of people that you should have some amount of money international. So even today, you have our traditional mutual funds. Just today morning, I was looking at a particular sector of a commodity fund, kind of pharmaceutical fund, or the infra funding, these kind of funds that you have, which are sectoral funds. Even in that, we saw some foreign names. So even the fund manager is probably thinking that he should, and of course, they have to have the approval to do that. But even they are buying some amount of international names. They are also holding some amount of non-rupee or dollar-based assets, if you like. So I think this is a lot of learning. About 10-15% of your portfolio, if it is in international investments also, I think that's not a bad idea, because you probably want your diversification over a period of time into a different currency also. So I think these 4-5 options might be a good idea to work
What
with.
about gold, silver, real estate?
Oh, so that all is no, not real estate, but gold,
Favorite
silver is a
Indian
part of our sectors. So within the sector, sometime you would be in pharmaceuticals, sometime in gold, sometime in silver. Okay, so let's say let's give a special treatment to gold and silver right now because the world is such. So then I would say that okay, let's have about 30% of the money wherein we have your aggressive equity, PMSs and things like that, say 15%, 15% to international, maybe put another 15 or 20% to gold and silver because that's how powerful this area is. And then the remaining 55%, you can go into equities and debt based on your preference. And the vehicles you can choose for that 55% could be your ULIPs and SIPs and mutual funds and even direct stocks if you're managing your own portfolio.
And of course, if life cycle funds is something you're interested in, wait for the dust to settle, wait for things to like settle down with both your life cycle funds and with your NPS, and then look at both of those asset classes. Of course, Karthik, I can't let you go without asking you this one question. There is a
Of
war.
course.
We are
Yeah.
seeing our investments lose value every day. So even while we are talking about building for the long term, we
Yes.
are seeing that what we've built is already eroding in value.
I know.
So, what would you have anybody who is, looking at the markets? I can see the screen behind you, a lot of red still.
Yeah. Yeah. Yeah.
Uh, what should a person do in a scenario like this? And are there any asset classes that you would have people move into right now?
Well, I mean, don't be fooled by the screen. Today is looking much better, actually. Today, there are a lot of green dots, also green spots, but there are days where it was like completely red, very, very horrible sort of screen. But one of the best things you can do is, don't look at the market these times. Go for a holiday. Go somewhere else because, or do something else because that's the best way to manage crisis. Because if you're here, you're bound to take a wrong decision. You're bound to say that, oh, let me just, get out, let me do something else, let me do something else. And the thing is, you will never have the right time to come back in. If you, of course, had the cash, you would want to invest. Invest a little bit every day. We don't know, when it's going to end. Because the third point is the most important point. And there was once where we did a study of the last almost 400 years of war. Okay, not even 400 years actually. We went down to as much as even the 10th and 11th century, and so there was not so much of economics and commerce and stock market at that point of time. But you could actually see the situation, and there were some reports where you could see that whether trade flourished or it didn't flourish. So everything came back to normal within about 2 to 3 months. So despite the war, and the thing about wars is that these wars have been going on through and through. The recent example being the Ukraine-Russia war started in 22, but it's not over. It's still going on. But everybody else has started moving on with the life as usual. So even if this Israel and Iran war or the US Israel and Iran war, if it goes on after a point of time, see the whole world is going to gang up against them and saying, look, you want to fight, you go ahead and fight, do what you want. Just open that strait and let the oil tankers pass to us because we need oil for our work, we need oil for our industrialization and things, and then you all keep fighting, you all do what you want, and then side treaties and negotiations, etc., will keep happening. Let's just hope that sanity prevails and they decide to take the war out of the commercial equation and things come back to normal. It always has, and not only for this time, but the precedents that I only explained was Ukraine and Russia, but there have been multiple precedences before that for all the wars that happened. Within a year's time, 6 months' time, the returns have worked good, everything was fine. And these then, on hindsight, became some very nice spots where even if you had 5 lakhs to invest or 25 lakhs to invest, those turned out to be very lucrative investment decisions, or they turned out to be the best decisions because the returns that they made were the best in the years to come. So the same will apply right now. I mean, there is everything which is available on a grand sale. So if people don't make use of it, then and the unfortunate part is when everything comes back to normal and when the markets are back to 25, 30,000 on the Nifty, then people say, oh, now we are in a bull run. But what happened? You just lost like a great 40, 50% run already. So
So essentially, what Karthik is telling us is stay put, and if you have the money, you can
he's
start
at
buying in small increments. But
absolutely right.
possibly the worst time to sell or exit your investments right now, because
Yes,
the red that you're seeing on the screen behind Karthik is also fear that is sort of overtaken the markets. So pleasure speaking with you, Karthik, as always,
always.
and hopefully when the markets turn green again, we can continue our discussions of
Yeah,
building wealth for longer lifespans.
absolutely. Look forward
Right.
to that.
And to our viewers, just putting aside funds for retirement is not enough, not anymore. Longer lifespan means our needs have changed and our money needs to last longer and it needs to work harder for us. So if you haven't watched it yet, on your screen, I am putting up a link of the last conversation that I had with Kartik on how to live to 100 without going broke. So watch it and you will see why the retirement plan that you've been working with is not enough. And of course, subscribe to the Never Too Late channel for more such India centric conversations to prepare for that 100-year life. Thank you for watching.